The latest U.S. jobs report is out, and it shows weaker than expected employment growth for the month of September. 136,000 non-farm jobs were created in the U.S. last month. Analysts were looking for a rise of about 145,000, so coming in slightly less than expected. The unemployment rate ticked downwards to 3.5%. That's another half-century low, 50-year low, but wage growth came in weak and also missed estimates as well. Stock futures had been lower before the release of the report, but have since, take a look here, turned mostly flat. This comes after an extremely volatile day for stocks on Thursday. Stocks swung wildly after a report showing weaker than expected growth in U.S. services sector, which is the largest sector of the American economy by far. All the major averages were able to claw their way back from steep losses to finish in the green, with tech stocks as the big gainers. That said, stocks are still down sharply for the week after back-to-back sell-offs on both Tuesday and Wednesday. It is the worst start to a quarter for the major averages in years. Let's get right to the drivers, and let's take a closer look at the jobs report we got today. Paul and Monica is standing by for us. So, Paul, let's just start with manufacturing, because that is probably the sector that stood out to a lot of us. When you see manufacturing decline by 2,000 jobs, how much concern is there about the effect of the trade war on the U.S. economy?
Yeah, I think it's a very legitimate concern, Zane. Obviously, the trade war has only really intensified in recent months, despite some hopes for a trade truce with China. We obviously have an escalation of some of the tariffs now imposed on goods from the EU. So geopolitical concerns, I think, are definitely going to continue to weigh on big businesses and the job market. So those manufacturing numbers that we saw slide last month, it's going to be very noteworthy to watch what happens in the next few months if you see continued weakness in the manufacturing sector, because this has been a pretty solid jobs report, but that did strike out as one weakness.
So manufacturing makes up about 10% of the U.S. economy. How real is the fear that this is going to take the service sector with it, just in terms of manufacturing slowing down and seeping into the service sector eventually?
Yeah, I mean, I think there had been hopes that the manufacturing weakness would not impact services, but then we got that ISM services number yesterday, which really showed that we are starting to see a slowdown even in non-manufacturing sectors as well. So I think there is a bit of a bleed over, and that is a concern. It does heighten the possibility that the U.S. economy will start to slow a little bit more dramatically in 2020, even if it's not necessarily a recession per se. So I think clearly the weakness in manufacturing is spilling over to other parts of the economy, and that's something that a lot of people are going to keep an eye on. I mean, keep in mind, these jobs numbers, while good, the gains that we've seen in jobs average monthly for 2019 are considerably lower than what we had in 2018. So we are losing momentum, even though we're still gaining jobs.
And another area where we're losing momentum is in wage growth as well. So what can you tell us about that?
Yeah, wage growth year over year dipped to 2.9% in the most recent report. That's obviously not great news for people looking at their paychecks, but there are two positive signs here. One, the wage gains are still higher than the rate of inflation, so many consumers still are able to at least keep up with what the price increases are with their wage increases. And also, you hate to make it about the markets and the Fed, but that is obviously a big part of the equation. This is a number, that wage growth below 3%, the Fed probably can take a deep sigh of relief that inflation pressures may be coming off the table a little bit, despite that spike in oil we had a couple of weeks ago. And that probably gives the Fed more reason to cut rates, if not at the end of this month, then most likely in December.